So, I want you to imagine for a moment that you started investing in 1998. The world's going mad for the internet. New companies are popping up out of nowhere, and every investor is convinced they've found the next big thing. So you take all your money and invest it in a few tech stocks just because they have catchy .com names, and for a couple of years your money keeps going up and everyone thinks you're a genius until the year 2000. Nothing short of breathtaking, a points drop never before seen on the US markets. Traders and investors shell-shocked. And spare a thought for Bill Gates, the Wall Street collapse cost the world's richest man $1.8 billion in 1 week alone. When the bubble burst, the Nasdaq fell nearly 80%, and only 48% of .com companies managed to survive. I watched many of my friends lose millions within a blink of an eye, and even though it was a crash I'd half been expecting, my own investments still took a hit. The crazy part is, the internet was the next big thing, but even then, the overconfidence and hype created one of the biggest bubbles in history. So why am I telling you all this? Well, fast forward to today, and I can't help but feel that same energy again, but this time, it's not driven by the internet, it's AI. People are calling it a once-in-a-lifetime opportunity, and maybe they're right. Or maybe it's the same story playing out all over again. History doesn't repeat, but it rhymes. And every generation thinks they've found a new era. But as John Templeton said, the 4 most expensive words in investing are, "This time it's different." But is this time actually different? Well, I feel a responsibility to give you my honest take on this situation. So before you panic, let's take a step back and look at the 3 hidden forces behind this potential bubble, why they matter, and what you can do to benefit from all this mayhem. And if you get any value out of this video, give it a thumbs up so more people can see it. Right now, the fate of the entire stock market and your portfolio is being decided by just 7 companies. They're called the Magnificent Seven. These are Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, they now make up around 36% of the entire S&P 500, and they're all locked in an arms race to dominate artificial intelligence. So, even if you only own 1 share of the S&P 500, you're already betting on these companies. And whether you realize it or not, your future returns depend on how this race plays out, because every dollar these companies invest sends ripples through the whole market, from chip makers to energy companies to your index funds. And when you see how much they're predicted to pour into AI this year, you'll understand why. Let's go one by one. Tesla plans on spending $5 billion on autonomous driving and xAI, which is Elon Musk's new AI startup. Apple, $10.7 billion to make Siri smarter. To be honest, it's probably going to take more than that. Meta, $60 billion on data centers and the metaverse. Google, $75 billion rebuilding the internet with AI. Microsoft, $80 billion funding OpenAI and supercomputers. And Amazon, $100 billion on AWS to own the infrastructure everyone else relies on. That's a total of $330 billion in 1 year. To put that into perspective, that's more than the entire GDP of countries like Finland or Portugal. All that money is going into building the future. Some people are even calling it the 4th Industrial Revolution. I get it. This all sounds pretty exciting. However, all of this spending seems to be what's keeping the economy alive at the moment, and without it, the US might already be in a mild recession. So the question is, how long can it last? Well, it doesn't seem to be ending anytime soon. Global AI spending is expected to reach $500 billion by the end of 2026, with spending on power and resources for electricity demand topping $3 trillion annually by 2030. That's how bad these companies want to win the AI arms race. I mean, I can see why. The International Monetary Fund estimates that about 60% of jobs in the developed world are exposed to AI. This means they could be transformed or replaced by automation in the coming years. So whoever manages to crack this technology first will be rewarded with a crazy amount of power. Mark Zuckerberg even said, if Meta end up misspending $200 billion, it's worth it because if they move too slowly, they're out of the competition. But this race isn't just between companies anymore, it's between nations. The US and China see AI as the key to global dominance, and they're both burning through billions to make sure they're the ones holding the reins. For everyday investors, this could go two different ways. If AI delivers on its promise, the next decade of investing could be just like the internet boom of the 2000s. But if the profits don't arrive fast enough, the same stocks pumping up your investment portfolio today could drag it down tomorrow. But where is all this money coming from? Well, that brings us on to something that blew my mind when I first discovered it. It's being referred to as the AI money machine. It's the main reason I'm starting to get worried about the state of the AI industry. So let me walk you through how it all operates. Intel, AMD and Nvidia are the companies that design the chips that power the AI models. OpenAI and xAI and other smaller players are the companies that buy these chips. Then you have Oracle and CoreWeave. These are the data centers who also buy these chips, then lease out the computing power to the AI companies. Think of them like the middlemen. At first glance, nothing seems out of the ordinary, but once you look at how these companies actually work together, the red flags start jumping out. It started when investors at Microsoft gave OpenAI $58 billion in funding. OpenAI then paid that back to Microsoft to use their data centers. Microsoft then used that money to buy Nvidia chips. Nvidia then invested that back into OpenAI. Doing this allows each company to record that flow as revenue, which of course pushes their stock prices up. It's kind of like if I went out into the woods with a friend and paid him $1,000 to dig a hole, then he paid me $1,000 to fill it back in. We then both have $1,000 in revenue. Now, if we were valued like OpenAI, which is currently trading at more than 40 times its revenue, that would mean our whole digging and filling business would be worth over $40,000 each. Obviously, I'm heavily simplifying things here. These companies aren't just passing around the same money, however. The idea remains the same. And this has only been getting crazier recently, with OpenAI announcing a deal worth $300 billion with Oracle. After this, Oracle said they would spend tens of billions on Nvidia chips. Then Nvidia agreed to invest up to $100 billion back into OpenAI. But to unlock that investment, OpenAI has to buy more of their chips. Nvidia are definitely the real winners here. Their share price is up 1,600% since ChatGPT launched, and they sell their chips to everyone. I'm talking Microsoft, Meta, Google, Amazon, OpenAI, and even Oracle. Then they invest back into the same companies that buy its products. This is like paying your customers to buy your product and could be artificially boosting the demand for their chips. Do you see how messy this is all getting? Let me try and simplify it. Nvidia sells the shovels, Oracle provides the land, OpenAI digs the quarry, and they're all helping each other to lure people into the mines. But nobody's struck gold yet. I mean, OpenAI is currently valued at $500 billion, but it's only making roughly $12 billion in revenue. It's losing money every month. Now that's the main problem I see with all of this. AI services are just not making enough money. So will these AI companies ever make the kind of profit needed to justify their stock prices? Well, it is possible, as they do still have some huge levers they can pull. I mean, each week over 700 million people are using ChatGPT. That's a huge amount of attention, and even more importantly, an enormous amount of data about all of us. Imagine when they turn on ads and allow companies to use ChatGPT to recommend their products directly inside our conversations. It could be like nothing we've ever seen before. In addition to this, OpenAI has surprisingly announced that it will start to allow erotica in its chats for verified adults, which of course is a huge industry. On top of that, these AI companies are building systems that are aiming to undercut the human workforce. They're betting that once corporations become dependent on AI, they'd have no choice but to keep paying, no matter the cost. And that's when the AI companies could hike prices sky high and finally cash in. So there's no doubt these AI companies are valuable, but much of that value still depends on one thing, the belief that progress will keep accelerating. And that leads us on to the third hidden force. AI has been improving at a breakneck speed for the past couple of years. I mean, we've gone from AI videos that look absolutely terrible to something that's almost indistinguishable from reality. It's funny that Will Smith eating spaghetti has become one of the ways we now judge AI's improvement. The stock market is relying heavily on the rapid rate of improvement to continue. However, we're not far off hitting something called the data wall. For years, AI has been devouring every scrap of public data available. By 2027, it's expected to have consumed nearly all human-generated online content. It's like climbing a ladder in a game of snakes and ladders. Everyone assumes the ladders will keep going, but we're running out of data to climb, so we might have to start moving square to square instead. I mean, just think how long the data sets that we're feeding AI have taken to build. Centuries. No wonder progress seems to have been so rapid as we've been feeding it books, research and data going all the way back to ancient history. And I'm not talking about myself here. If AI companies can't find a way to scale beyond the data wall, we could see progress slow down, expectations collapse, and the bubble many investors are banking on finally bursting. But is beating the data wall actually possible? Potentially. Think about it. Humans don't have to worry about this data limit. That's because we don't just learn from being fed data. We learn from interacting with the world. I mean, if AI tried to make this video, it couldn't. It hasn't lived my life, had my conversations, or made my investing mistakes. My perspective comes from my experience, which is something AI can't simulate. So in my opinion, scaling past the data wall is possible, but it isn't just a question of more data. It's a question of different data. But look, I'm not a scientist, so let's get back to investing in the stock market. So I started this video by comparing what's happening now to the dot-com bubble of the late 1990s. However, is it actually the same? No, not entirely. The main difference is that these AI companies have real utility and a clear path to profits. How big those profits will end up being remains to be seen. However, it's a much better situation than the dot-com bubble, where companies were getting their crazy valuations from fancy names alone. So does that mean it's not a bubble? Well, honestly, I still think it is. The signs are all there. Overvaluation, faking revenue, geopolitical mania, and scaling limits. However, there's no way of telling what stage we're in. This could be the start of a decade of crazy investment, or closer to the end than we realize. So what's the best thing to do with your money? Well, I'm not a financial advisor. However, these are the things I'd be focusing on if I were you. Firstly, continuing to invest. If we're at the start of the bubble, then the prices we're seeing right now could seem like bargains in a couple of years' time. That's why it's so important to set up an automatic investment that leaves your account every month and goes into a broad, low-cost index fund. I did this during the dot-com bubble, and although my investments took a hit when the bubble burst, I don't regret a thing, as over time the market bounced back, as historically it always has. The real secret is not to panic when your portfolio goes down. As long as you're investing in an index fund that tracks the overall stock market, then continuing to invest through a crash could be the best thing you ever do. That's how I ended up making millions from the dot-com bubble bursting. But in order to do this, you need to make sure you're not in debt or over-leveraging yourself. This is exactly why my friends lost millions while I was able to keep investing. Secondly, focus on increasing your income. Your income is the fuel you're using to grow your wealth. So if you can increase it by getting a promotion or starting a side hustle, then that's going to supercharge your returns, especially if you can do this while the stock market's falling, because you'll be picking up some bargains. Thirdly, focus on diversification. Putting all your money into one type of investment is a recipe for disaster. The key to surviving market bubbles is diversification. This means spreading your money across different types of assets. My portfolio includes stocks, bonds, precious metals like gold, real estate, and even cryptocurrency. It's also worth considering dividend-paying stocks, as they actually perform well during downturns because they generate passive income even when prices are low. Now, let me talk about why this matters for regular people like you and me. Because here's the thing that most people miss about market bubbles. They're not just about rich people losing money, they affect everyone. When the dot-com bubble burst in 2000, it wasn't just tech investors who suffered. Pension funds lost billions, retirement accounts were devastated, people who thought they were set for life suddenly found themselves working extra years just to make up for their losses. And the same thing could happen with AI. If you have a 401k or any kind of retirement account, chances are you're already invested in these magnificent 7 companies, whether you know it or not. Your financial future is tied to this AI race, and that's why understanding what's happening is so important. But here's where it gets really interesting. During every major market bubble, there are always winners and losers. The losers are the ones who panic, sell at the bottom, and lock in their losses. The winners are the ones who understand what's happening, stay calm, and actually use the downturn to their advantage. I've seen this play out multiple times in my investing career. In 2000, I watched friends sell everything at the worst possible moment. Then I watched the market recover, and those same friends miss out on the biggest gains because they were too scared to get back in. The same thing happened in 2008 during the financial crisis. Everyone was panicking. The news was telling us the world was ending. But the people who kept investing through that chaos ended up making fortunes over the next decade. And that's the lesson I want you to take away from this video. Market bubbles are scary. They're designed to make you emotional. But if you can keep your head while everyone else is losing theirs, you'll come out ahead. Now, let's talk about some specific strategies for navigating this potential AI bubble. First, understand the difference between speculation and investment. Speculation is buying something because you think the price will go up. Investment is buying something because you believe in its long-term value. Right now, a lot of people are speculating on AI stocks without really understanding what they're buying. Before you put money into any AI company, ask yourself these questions. Does this company actually make money? What's their path to profitability? How much competition do they face? What happens if AI progress slows down? If you can't answer these questions, you're not investing. You're gambling. And gambling with your financial future is never a good idea. Second, don't try to time the market. Nobody knows when this bubble will burst. It could be next month, next year, or 5 years from now. Trying to predict the top is a fool's game. Instead, focus on what you can control: your savings rate, your asset allocation, your debt levels. These are the things that will determine your financial success in the long run, not whether you manage to sell your Nvidia shares at the perfect moment. Third, keep some dry powder. This means having cash available to invest when opportunities arise. During a market crash, everything goes on sale. If you have cash ready, you can buy quality assets at discounted prices. I always keep a portion of my portfolio in cash or cash equivalents for exactly this reason. It might seem like a drag on returns when the market is going up, but when the crash comes, you'll be glad you have it. Fourth, think about your time horizon. If you're in your 20s or 30s, a market crash might actually be the best thing that could happen to you. It gives you the chance to buy assets at lower prices and let them compound over decades. But if you're close to retirement, your situation is different. You might want to reduce your exposure to volatile assets and focus more on capital preservation. The point is, your strategy should be based on your personal situation, not what some talking head on TV is saying. Fifth, pay attention to the fundamentals. At the end of the day, stock prices are supposed to reflect the value of the underlying businesses. When prices get too far ahead of fundamentals, a correction is inevitable. Right now, many AI stocks are trading at valuations that assume everything goes perfectly. They're priced for a future where AI transforms every industry, and these companies capture all the profits. But what if that doesn't happen? What if progress slows down? What if new competitors emerge? What if regulation steps in? Any of these things could cause a significant repricing of AI stocks. And if you're invested at today's prices, you could see substantial losses. That doesn't mean you should avoid AI stocks entirely. It just means you should be realistic about the risks and size your positions accordingly. Sixth, diversify globally. The US stock market has been the best performer over the past decade, but that's not guaranteed to continue. Other markets around the world offer different opportunities and different risks. By spreading your investments across multiple countries, you reduce your dependence on any single economy. If the US AI bubble bursts, your international holdings might help cushion the blow. Seventh, consider alternative assets. Gold has been a store of value for thousands of years. Real estate provides rental income and appreciation potential. Bonds offer stability and regular income. Even cryptocurrency, despite its volatility, has a place in a diversified portfolio. The key is not to put all your eggs in one basket. No matter how exciting AI seems right now, you don't want your entire financial future depending on it. Now, let me address something that might be on your mind. What if I'm wrong? What if AI really is different and these companies are going to dominate the global economy for decades? Well, that's certainly possible. And if it happens, you'll still benefit by following the strategies I've outlined. Diversified investors will still make money from AI even if they don't have their entire portfolio in Nvidia. But if I'm right and this is a bubble, then the strategies I've shared will protect you from the worst of the damage. It's about managing risk while still participating in the upside, and that's ultimately what smart investing is all about. It's not about making the maximum possible return, it's about making solid returns while protecting yourself from catastrophic losses. Because here's the truth that most people don't want to hear. The people who get rich from investing aren't usually the ones who hit home runs. They're the ones who consistently hit singles and doubles while avoiding strikeouts. They're the ones who keep investing month after month, year after year, regardless of what the market is doing. They're the ones who don't panic when prices drop and don't get greedy when prices soar. They're the boring investors. And boring investors almost always win in the long run. So as we wrap up this video, I want to leave you with this thought. The AI revolution is real. The technology is transformative. But that doesn't mean every AI stock is a good investment at today's prices. Be careful, be diversified, be patient, and most importantly, don't let the hype make you do something you'll regret. History doesn't repeat, but it rhymes. The dot-com bubble taught us that even revolutionary technology can be overpriced. The AI bubble might teach us the same lesson. But if you're prepared, you won't just survive it, you'll thrive. Just remember, this bubble bursting won't be the end of the world. If you understand situations like this, then you won't be the one panicking, and you'll be the one taking advantage of the opportunities while everyone else is running for the exit. Stay smart, stay diversified, and keep investing for the long term. Take care.